Security analysis. Write a short notes on anticipatory surveys. Anticipatory surveys helps investors to form an opinion about the future state of the economy. It incorporates experts' opinion on construction activities, expenditure on plant and machinery, levels of inventory, all having a definite bearing on economic activities. Also, future spending habits of the consumers are taken into account. In spite of valuable inputs available through this method, it has certain drawbacks. Survey results do not guarantee that intentions surveyed would materialize. They are not regarded as forecast per se, as there can be a consensus approach by the investor for exercising his opinion. Continuous monitoring of this practice is called for to make this technique popular. Next, write a short notes on barometer or indicator approach. Various indicators are used to find out how the economy shall perform in the future. The indicators have been classified as leading indicators, roughly coincidental indicators, lagging indicators. Leading indicators, they lead the economic activity in the terms of their outcome. They relate to the time series data of the variables that reach high or low points in advance of economic activity. Roughly coincidental indicators, they reach their peaks and troughs at approximately the same in the economy. Lagging indicators, they are time series data of variables that lag behind in their consequences vis-a-vis the economy. They reach their turning points after the economy has reached its own already. All these approaches suggest direction of change in the aggregate economic activity, but nothing about its magnitude. The various measures obtained from such indicators may give conflicting signals about the future direction of the economy. To avoid this limitation, use of a diffusion or composite index is suggested, whereby combining several indicators into one index to measure the strength or weakness in the movement of the particular set of indicators. Computation of diffusion indices is no doubt difficult, notwithstanding the fact it does not eliminate irregular movements. Money supply in the economy also affects investment decisions. Rate of change in money supply in the economy affects gross national product, corporate profits, interest rates, and stock prices. Increase in money supply fuels inflation. As investment in stocks is considered as a hedge against inflation, stock prices go up during inflationary period. Write a short notes on Dow Jones theory. The Dow theory was originated by Charles Dow, the founder of Dow Jones Company in the late 19th century. It is a helpful tool for determining the relative strength of the stock market. It can also be used as a barometer of the business. The Dow theory is based on the movements upon the movements of two indices constructed by Charles Dow: Dow Jones Industrial Average (DJIA) and Dow Jones Transportation Average (DJTA). The movements of the market are divided into three classifications, all going at the same time: the primary movement, the secondary movement, and the daily fluctuations. Primary movement. Primary movement is the main trend of the market, which lasts for 1 year to 36 months or longer. That means 1 year to 3 years. This trend is commonly called as bear market or bull market. The secondary movement. The secondary movement of the market is shorter in duration than the primary movement and is opposite in direction. It lasts for 2 weeks to 1 month or more. Daily fluctuations. Daily fluctuations are the narrow movements from day to day. These fluctuations are not part of a Dow theory interpretation of the stock market. However, daily movements must be carefully studied along with primary movements and secondary movements as they go to make up the longer movement in the market. Thus, the Dow's theory purpose is to determine where the market is and where it is going, although not how far or high. Charles Dow proposed that primary uptrend would have three moves up. First one, accumulation; second, arrival; third, widespread. The first one being caused by accumulation of shares by the far-sighted, knowledgeable investors. The second move would be caused by the arrival of the first reports of good earnings by corporations. And the last move up would be caused by widespread report of financial well-being of the corporations. The third stage would also see rampant speculation in the market. Towards the end of the third stage, the far-sighted investors, realizing that high earning levels may not be sustained, would start selling, starting the first move down of a downtrend. And as the non-sustainability of high earnings is confirmed, the second move down would be initiated, and then the third move down would result from distress selling in the market. Write a short notes on Elliott wave theory. Elliott found that markets exhibited certain repeated patterns or waves. As per this theory, wave is a movement of a market of the market price from one change in the direction to the next change in the same direction. These waves are resulted from buying and selling impulses emerging from the demand and supply pressures of the market on the market. Demand and supply pressures on the market. Depending upon the demand and supply pressures, waves are generated in the prices. As per this theory, waves can be classified into two parts: impulsive patterns, corrective patterns. Impulsive patterns means basic waves. In this pattern, there will be 3 or 5 waves in the given direction going upward or downward. These waves shall move in the direction of the basic movement. This movement can indicate bull phase or bear phase. Corrective patterns, that is reaction waves. These 3 waves are against the basic direction of the basic movement. Correction involves correcting the earlier rise in case of bull market and the fall in case of bear market. As shown in the following diagram, wave 1 and 3 and 5 are directional moments which are separated or corrected by wave 2 and 4, termed as corrective moments. 1, 2, 3, 1, 3 and 5 are directional moments. 1, 3 and 5 are directional moments, and 2 and 4 are corrective moments. Next, write a short notes on random walk theory. Stock market prices cannot be predicted. For many years, economists and statisticians have been interested in the developing and testing models of the stock price behavior. One important model that has evolved is the random walk theory. Stocks follow a random walk. If the price of the stocks does not reflect any pattern, logic behind random walk theory is we consider that stock price tend to change according to the information. That means stock price should change when the market gets new information related to that stock. Since such kind of information arrives in an unpredictable and random manner, we can say that stock prices should change in a random and unpredictable manner. In short, it may be said that prices on the stock exchange behave in a similar manner a drunk behave while walking down the streets. The supporters of this theory put out a simple argument. It follows that price of shares in the stock market cannot be predicted. The reason is that price trends are not the result of any underlying factors, but that they represent a statistical expression of past data. There may be periodical ups or periodical downs in share prices, but no connection can be established between two successive peaks, that is high price of the stocks, and troughs, that is low price of the stocks. What conclusions were drawn from the random walk theory that lead to the evaluation of an efficient market hypothesis? When empirical evidence in favor of a random walk hypothesis seemed overwhelming, researchers wanted to know about the economic process that produces a random walk. They conclude that a randomness of stock price was a result of efficient market that lead to the following viewpoints. Information is freely and instantaneously available to all market participants. Keen competition among the market participants more or less ensures that market will reflect intrinsic values. Price change only responds to new information that is unrelated to previous information and therefore unpredictable. Write a short notes on efficient market hypothesis. Efficient market hypothesis states that it is impossible for an investor to outperform the market as the available price sensitive information are already included in the market price of the securities, and thus investors cannot purchase the securities which are undervalued and sell it at inflated price. This theory explains that market price of the share is fair price. An investor can earn higher returns only by having riskier assets in his or her portfolio. 3 forms of market efficiency: weak form of efficiency, semi-strong form of efficiency, strong form of efficiency. Weak form of efficiency: current market price captures all information contained in past stock price and volume data. Semi-strong form efficiency: Current market price captures all publicly available information. Strong form of efficiency. Current market price captures all information, both public as well as private information. Lessons of market efficiency. Markets have no memory. Price changes tomorrow are independent of price changes today. Fair market prices. As the current market price captures all information, the price quoted in the market is considered as fair market price. Read the entrails. If the market is efficient, it can suggest a great deal about the company's future prospects. What are the misconceptions about efficient market theory? It is not possible to earn consistent long-term returns. Efficient market theory implies that market prices factor in all available information, and as such, it is not possible for an investor to earn consistent long-term returns from market operations. Stock price does not reflect fair value. Although price tends to fluctuate, they cannot reflect fair value. This is because the future is uncertain. The market springs surprises continually, and as prices reflect the surprises, they fluctuate. Portfolio managers lack competence in an efficient market. Inability of institutional portfolio managers, institutional portfolio managers to achieve superior investment performance implies that they lack competence in an efficient market. It is not possible to achieve superior investment performance since market efficiency exists due to portfolio managers doing this job well in a competitive setting. Stock market is irrational. The random movement of stock price suggests that stock market is irrational. Randomness and irrationality are two different things. If investors are rational and competitive, price changes are bound to be random. What are the three levels or three forms of efficient market theory? First one, weak form of efficiency, semi-strong form efficiency, strong form efficiency. Weak form efficiency. Current market price captures all information contained in the past stock price and volume data. Semi-strong form efficiency. Current market price captures all publicly available information. Strong form efficiency. Current market price captures all information, both public as well as private. What are the challenges faced by efficient market hypothesis? Limited information processing capabilities. Human information processing capabilities are sharply limited. According to Herbert Simon, every human organism lives in an environment which generates millions of new bits of information every second, but the bottlenecks of the perpetual apparatus does not admit more than 1000 bits per second and possibly much less. Irrational behavior. It is generally believed that investors' rationality will ensure a close correspondence between market prices and intrinsic values, but in practice, this is not true. L.C. Gupta, who found that market evaluation processes work haphazardly, almost like a blind man firing a gun. The market seems to function largely on hit or miss tactics rather than on the basis of informed beliefs about the long-term prospects of individual enterprises. Next, monopolistic influence. A market is regarded as highly competitive. No single buyer or seller is supposed to have undue influence over the prices. In practice, powerful institutions and big operators wield great influence over the market. The monopolistic power enjoyed by them diminishes the competitiveness of this market. Explain buy and sell signals provided by moving average analysis. Buy signal. Stock price line rise through the moving average line when graph of the moving average line is flattening out. In case of sell signal, stock price line falls through moving average line when graph of the moving average line is flattening out. Next, in case of buy signal, stock price line falls below moving average line which is rising. In case of sell signal, stock price line rises above moving average line which is falling. In case of buy signal, stock price line which is above moving average line falls but begins to rise again before reaching the moving average line. In case of sell signal, stock price line which is slow moving average line rises, but stock price line which is slow moving average line rises but begins to fall again before reaching the moving average line. These three are the signals pertaining to buy. These three are the signals pertaining to sell. What is the difference between fundamental analysis and technical analysis? Fundamental analysis. Fundamental analysis is the practice of analyzing securities by determining the intrinsic value of the stock. Technical analysis is a method of determining the future price of the stocks using charts to identify the patterns and trends. Fundamental analysis is relevant for long-term investments, whereas technical analysis is relevant for short-term investments. Fundamental analysis is used for investment purpose and technical analysis is used for trading purpose. Objective of fundamental analysis to identify the intrinsic value of the stock. Objective of technical analysis to identify the right time to enter or exit the market. Decision making. In case of fundamental analysis, decisions are based on the information available and statistic evaluated. In case of technical analysis, decisions are based on market trends and price of the stock. Fundamental analysis focuses on both past and present data, whereas technical analysis focuses on past data only. Form of data. Economic reports, news events, and industry statistics are the data considered for fundamental analysis. Chart analysis is the data considered for technical analysis. Future prices. Predicted. Future prices are predicted on the basis of past and present performance and profitability of the company. Here, in case of technical analysis, future prices are predicted on the basis of charts and indicators. Type of trader. In case of fundamental analysis, generally long-term position traders will be there. In case of technical analysis, swing traders and short-term day traders will consider technical analysis.